Madhav Dhar is here with us. Thank you so much for joining us, Mr. Dhar. And thank you for giving us your time. You know, for the last 15, 20 days, every day, whenever I speak to a fundamental investor, someone who believes in the fundamentals and invests accordingly, they say that the markets are too expensive and there's an impending correction or a collapse coming. Technical analysts have no reason to believe that, and they keep looking at the markets and they say it's going to keep going up. It just keeps going up. What is driving it?
Well, it's like a debate between two religions, you know, between fundamentals and technicals, and each believes things fervently. It doesn't make them right. So, I mean, markets are, you know, a complex of liquidity, technicals, fundamentals, and most importantly, the future. So, I think if you look at what's propelling markets, I mean, firstly, I mean, global factors are, you know, pick a number, 2/3 to 3/4 of what drives Indian markets, and you have an extraordinary confluence of extremely positive factors, which is huge amounts of global liquidity, negative interest rates in many parts of the world, and actually very strong and accelerating data from the US. So it's you know, what is called a Goldilocks scenario. It's neither too hot nor too cold. It's not hot enough for rates to go up, and it's not cool enough for the economies to be in trouble. So it's a positive, perfect storm, and you have that backdrop. You know, you overlay it on India, where you finally have GST passing. Some of the uncertainties we have at least come down, if not gone away. There's a little more progress on the banking side. And importantly, although it doesn't look like industrial production is really picking up sharply, things certainly seem to have bottomed out. Profit margins that are at 2-decade lows seem to have bottomed out. So to me, that's sort of what's happening, that India is an island of growth in a growth-starved world. So it has a relative advantage, and global cues on growth and liquidity are actually fantastic. So yes, the markets are expensive. Yes, they're not cheap, but it's never meant to be an easy game.
But is this something that is a deja vu situation for you? Have you seen this happen before? Negative interest rates, deflation in Europe, signs of deflation in Europe, not necessarily happening right now. US growing. Have you ever seen that before? I think
there is no question. There is no question. Well, I think there's no question we're in uncharted waters. I mean, I think you have to go back 150 years to see negative interest rates in any meaningful way. You've seen whiffs of deflation in Japan. So yes, you've had pockets of deflation and interest rates, but on a global basis, I think you've had really two data points in modern times, which was 1929 to 1936 around the world, triggered by the US Depression, that then spread around the world, and you've had the post Great Recession scenario starting 2009, 2010. So no, you don't have a lot of data points. I think the coordinated attack against deflation by the global central banks is unprecedented. And you could argue that it has succeeded in terms of keeping the world afloat and certainly in propelling asset values. But you could debate whether it has solved some fundamental structural issues of growth and employment around the world. So it's still work in progress, and it's work in progress in an unprecedented way, in uncharted waters.
Madhav Dhar, let's dip into your experience. And if I'm not mistaken, you yourself were a person who invested in the so-called emerging markets at one point, sitting in New York and then traveling to Moscow, if I'm not wrong, with guns surrounding you to save your money to invest in, so that no one takes the dollars from you. Now, dip into that experience and tell us, how does a big investor or a person who's investing for a big fund, how do they look at an India story? Do they actually look at individual stocks, or they just look at the big index and sees Nifty is going up? This is likely. Let me just buy the Nifty and not bother about anything else. What do they do?
Well, I think the world has changed from 20, 30 years ago when I started this sort of business. And in those times, the markets were extremely thin. And if you had any sizable amount of money to bet on, you really were betting on the country. And at best, you were occasionally betting on a sector. At best. I mean, so picking and choosing this stock versus that stock, firstly, the pools of money weren't geared towards that. They were really country funds. Second, if you wanted to, just one or two or three stocks in a country would absolutely overwhelm the amount of money you had to invest. So you just didn't have the depth of liquidity. Right. So since that time, everything has changed. I mean, you have country funds, you have regional funds, you have hedge funds, you have sector funds, you have tech in all its forms, which is basically infiltrating other sectors, have their own pockets of investment, starting from venture to growth to mature. So the world has dramatically changed. But as I started by saying, whether you like it or not, somewhere between 2/3 or 3/4 of your total returns are going to be macro related. So everyone's perplexed why India is going up. I mean, the world is going up. There's nothing to do with India. I mean, nothing that we have done as a country, whether it's policy or corporate environment, that has created Nifty pretty much at an all-time high. The S&P is at an all-time high. That's why the Nifty is at an all-time high. Right. So whether you like it or not, you have to figure out, A, are you comfortable with the world or not at a macro level? B, are you comfortable with India in terms of its own inflation and growth and policy dynamic? And third level would then be, are there sectors or stocks that you prefer within that country? So it's always a cop-out to say, well, I don't really care about the market, I just pick stocks. I mean, that's rubbish. It's a simplistic thing to say that people like to say it because they don't want the responsibility of making a judgment on what's happening on the market. So I think that's the way the world goes.
Right. So the reason I was also asking this is that we've heard of all these algos and, literally computers investing. And they just, a change in risk premium overnight can make millions of dollars move out from one market to another. Is this current rally being driven by these ETF-oriented funds? The reason I'm again asking is because that's very liquid. One single trigger, the Fed says, okay, we are raising interest rates, and that can actually lead to an overnight movement. Is that likely to happen?
I think it's certainly possible. I don't think it has anything to do with ETFs or algos. I think that is change. It is to do with a fundamental change in the macro outlook. If the Fed decisively raises rates, it is signaling it is the end of an easy money era that we've had, since 2008. So that's a huge fundamental change. That has nothing to do with overnight or technical or trigger-happy computer nerds, and that is something very fundamental. That growth in the U.S. is fine, interest rates are moving up, and then money will reprice relative returns and relative risk. And some of the emerging markets, historically tend not to do well in that kind of environment. So I have no reason to believe that this time will be anything different. What may be different and supportive for India is as and when it happens, which is, I think, sort of inevitable, whether it's later this year or early next year, that I think the Indian cycle in itself should be turning. The Indian growth cycle. So in a way, if the tide goes out, our own boat hopefully should be accelerating into that tide. So it ought not to be as bad as in previous cycles, but remains to be seen. And there's a lot of work.
Again, let us dip into your experience there
on a policy basis.
Because if I look at, have you ever seen a situation where US is on the way of tightening liquidity and Europe has to ease or Japan has to ease? Have you seen that before?
No, I mean, to some extent you could say that we've seen it in the last year or so, right? I mean, the Fed did raise rates and Japan did lower rates.
Yeah.
So you've had little
last
pockets
1 year,
of that.
this rally has been going on for some time. So before this last 1 year, is there any precedent which says, okay, this is what has happened in the past? Because this seems to be a new thing.
No, I can't. Yes, it is a new thing. I can't recall off the top of my head. I mean, usually the magnitude of reduction in rates or increase in rates is different, but for them to be in out of phase and counter-cyclical in terms of tightening and easing cycles has been unusual. And again, going back to India, I mean, India was in a tightening cycle, up until a few years ago, while the rest of the world was easing. Yeah. So in that sense, if structural inflation truly comes down in India, we have a lot more room to ease, giving further cushion to the Indian stock market as long as profitability really accelerates.
Okay, Madhav Dhar, let's look at India now specifically. You were just going to say that if and when the US Fed actually tightens rates, raises rates, it should coincide with a situation where our own boat is rising. Give me 3 key reasons why you think that boat is rising.
No. I'm saying our boat better be rising and accelerating. I'm saying there's a chance that's what happens. Otherwise, a decisive move in the interest rate cycle upwards in the US will be negative for all emerging markets, including India. I'm simply saying that India has a countervailing trend that I think we are in a slightly accelerating economy. So it's literally like, imagine that you're in an ocean
what
and the
makes you
ocean
think,
is the US.
Just tell our viewers, whatever, I gave a number 3, but it could be any number that you want, that makes you feel that we are beginning to accelerate now.
Well, I just think cyclically things look like they're turning up. The last few data points are sort of positive. I think the passage of GST is very positive. It will probably have actual material impact probably a year from now or later than that, but certainly has a good psychological momentum behind it. You will see the numbers come in to support it 12 months from now. The stock market's a forward-looking animal, so it'll start factoring that in. I think we've had some decisive progress led by the RBI on bank reform and restructuring and things like that. That, again, has a long way to go. We have a very depressed credit cycle, so the odds are it'll start turning. We have a very depressed investment cycle, which are frankly related. That'll start turning. We've had some sales of distressed assets. It has to go a lot further to re-liquefy the banking system so money can go back into the investment cycle. So none of it is obvious. None of it is something you can prove that is going to happen next month. But you can see 4 or 5 strands coming together that I think 12 months from now, if those trends keep going, I think they will have a material impact on GDP and on inflation. And I think GST in itself, we can argue whether it's 1%, 0.5%, or 2% to GDP. I think it's a GDP accelerator, it's an inflation diffuser, and it's a corruption eliminator. Many ways like the Aadhaar card. So I think GST, Aadhaar, all these things are very powerful trends. You overlay that into financial inclusion, especially through the mobile phone that is accelerating, internet penetration in India which is accelerating. Those are all very powerful but slow-moving trends. And I don't believe that, it's always one trigger that some policy change overnight will lead to something. I mean, it can happen, whether it's big-time privatization or labor market reform, but I just don't think it'll happen in India. So 1991, which was almost a digital shift in the Indian policy, I just don't think we are in that kind of political economic environment where some single trigger will unleash this country. I think it'll be slow moving and 2 steps forward, 1 step back. And I think we are about to be in a 2 steps forward phase. So I feel optimistic. I mean, just that markets have, obviously done well and valuations, I would say, are stretched, but are certainly high. And that's a bit of a countervailing force. So I don't feel overwhelmingly about the situation. And, I've learned, you're asking me to, draw from my experience. I've learned to sit tight sometimes and not get worried about valuations alone. I think if fundamentals start deteriorating, whether it's liquidity internationally in a material way or growth dynamics in India in a very specific way, that would worry me. I've learned over time never to worry about valuations as an isolated factor.
Right. Okay, let's take these up individually if we can and look at specific pockets in the market. Now, one of the things that you're looking forward to is asset sales, so that distressed assets are sold and the banks can get their money back and lend again. Asset sales, we've seen some of it. We've seen cement and power being sold. Generally, these are productive assets, right? These are the things which are getting them some money. They had to sell them, get out of that, and liquidate or pay back some of the loans. Now, some of these assets are now selling at slightly lower than what it was expected to sell at, right? That's what we saw the report suggesting. This means that when you have these asset sales take place, two things will happen. One is asset consolidation, and the other is asset price deflation. Now, if I'm sitting on, as you said, that there are people who would probably look at valuations of companies and they say, here is a company with so many megawatts of power, and they do the valuation, they're going to do it on some replacement cost or whatever way they want to do it. Suddenly the replacement cost has gone down, so that valuation of that company drops. I'm just saying two trends that are likely to happen. One is consolidation, other is asset price deflation. Do you agree that's likely to happen?
I think it depends. Yeah, they might, but I don't see why that's negative. It's still better than a bank stuck with an asset it doesn't know what to do with, or a bankrupt promoter stuck with an asset that they can't deploy. So if there is a distressed sale at a lower price and the market clears and the pipes declog and the arteries declog in the system, I think that's just fine. Who cares about a temporary depression or on a clearing price? I couldn't care less. I mean, if the government of India were to sell, its entire holding at a 20% discount to the market, and those assets went into productive hands, I think that's a win-win for everybody, including the country. I, as a taxpayer, would completely favor that.
But I'm looking at it from an investor's perspective in the stock markets, in the sense that, as I said, that if I have invested in a stock which had a notional value based on the assets held, if asset prices get deflated, even a person who actually has a good balance sheet but has these assets which give it a valuation is going to be affected by that.
Who doesn't know that? I mean, the markets are smart, very smart creatures. I mean, what makes you assume that the markets don't realize that if and when these assets are sold, that they will sell at some kind of clearing discount? So I'm sure that's priced in. I mean, the Nifties that are moving went right through all of these sales. So it's all priced in. I mean, a whole bunch of public sector banks are trading at a fraction of book value for a reason. Nobody believes in that book value. And perhaps rightly so. And perhaps, frankly, in my opinion, I think they are too discounted. But just the fact that you're selling at below book value tells you that people don't believe in book value. I think that's all accounted for. That's all adjusted. And the fact that there are distressed sales in India of any kind, I think the markets will take it as a positive, which means that people are coming to grips with what real economic reality is, and asset and credit are parting ways to clear the system.
Right.
It's like having heart surgery. I mean, you can pretend that there's no problem, but once you clear the arteries, things are much better off, even though the act of an angioplasty may not be a good thing.
Okay, so one important point, and let me try and get a little bit more on that, which is you believe that perhaps that PSU banks are going too cheap. Is that fair?
Listen, I think that's my broad instinct. Yeah. I mean, it's hard to prove because you really have to go through. I mean, I've looked at some of the
would you be a buyer of PSU banks? If you were a buyer, would you buy PSU banks right now?
Yes.
All right, that's about.
Yeah, I would.
What about private banks?
I don't know. I mean, listen. I mean, I think they are, extremely profitable. They're fantastically well run. They're very expensive. They're extremely overowned, and so I'm sort of indifferent. I mean, it's not my style. I tend to be a value contrarian buyer, and I think you can have more and more competition from all the fintechs and the startups. I think you have more licenses coming, and I mean, the private banking sector in India is much lauded. and to some extent rightly so, because some great bankers have built some great institutions. But I would like to say that A, that's true, and two, it's been an oligopoly. You know, that you have wounded competition in the state banks and you have licenses. So it's a small oligopoly in a booming market. It's hard not to make money.
Right. So you expect competition.
You'll have more competition in terms of more entrants. You'll have more competition. Absolutely, both from new entrants, brick and mortar entrants, and I think to new platforms and new apps in terms of fintech. So I think there'll be now a lot of the private sector banks themselves will adopt those technologies, and they'll be the big winners. But you know, many of them are trading at 4 or 5 times book value, and these are hardly unloved, undiscovered stories.
Okay,
so which doesn't mean they can't go up. It's just
when you say you're a contrarian value investor, IT. Huge correction there. Has the story completely changed there? Are Indian IT companies no longer going to be growing at the rate as they were? I know that obviously that growth has already slowed down. But are they like, as someone said, that are they now in the typewriter business when computers came in?
I'm not sure about that. I mean, that's obsolescence. I'm not sure. I think it's a little bit of what happened to Microsoft, you know, which is you go from a extremely high growth business to sort of a growth utility business. And if you don't self-correct, it'll go into a utility business. So it's hard to see typewriters. But I don't know. I don't know enough about it. I mean, that's my instinct that a deceleration is inevitable. That's a hugely competitive business, and it has squeezed the BPO thing to a great extent, and it needs to find the new thing. And many of the new things are in startups and in the big behemoths internationally. So the old line Indian tech, I think it's fine, but it has to compete, it has to innovate, it has to readapt and relearn things.
So
I don't think
they've lost the markets have already factored some of that in. They've really come down in terms of price earning multiples dramatically. Would you be a contrarian buyer there, or you'd wait?
I don't have a strong view. It's like the opposite of my private sector bank view. I mean, I need to have a big disagreement with the market. So, I mean, I was, I guess, on your show, and I rarely mention stocks, and but in February, when we talked about it, I thought the whole real estate sector in India, particularly the big firms like DLF, were almost too cheap, were being priced as if it had no assets and no future. So I think that's a big contrarian bet I took, and I'm not simply saying it because it worked. I'm saying because it's symbolic of the way I look at things, that I like to buy undervalued assets where fundamentals are improving and people are extremely skeptical.
Well,
and I think State Bank of India sort of fell into that category, and and those are
in which two sectors where if asset sales go through markets clear, as you said, things should improve. One is metal, steel, let's say, and the other is power. Are there any contrarian bets you're taking there?
Yeah.
I mean, if you can be kind and name some stocks, I'll be happy.
I'm watching them closely. No, I'm not going to name any stocks, but I mean, I mentioned both those sectors. I mean, in February, and by the way, not because something special was happening in India. When oil went below $30 a barrel, I mean, as a contrarian, and there was a full-blown panic sale in all commodities, particularly oil. I think that was a good contrarian trade to make, that people were just completely indiscriminate selling in commodities, and oil went below 30, that was the time to make a trade. Now, I happen to think that was just a trade, and it was a very successful trade, but right now, would I go long oil and all these assets? I'm not so sure, because that correction, that bounce has taken place. There's still massive oversupply of steel and metals around the world. I mean, copper is building up to another huge new supply, and you don't see industrial demand around the world to absorb it. So, no, I mean, you need to have a disagreement. I think oil is fairly priced. I think metals are fairly priced. I don't have a disagreement with the market. My
Any disagreement
has
on
been
the
on
way
things like,
markets are
State Bank
pricing
of India
capital
and
goods
DLF.
companies?
haven't looked at it carefully enough. It hasn't sort of shown up on my radar as a sort of a 2 standard deviation event that bears further investigation.
Anything
I mean,
else
as Warren
other than
Buffett
PSU
famously
banks?
said, one of the hardest things to do is to sit in a room and do nothing.
Anything other than PSU banks where you feel that you have that 2 standard deviation event disagreement, or even a 1 standard deviation disagreement? I understand.
Well, one already happened that I talked about. I mean, it's one of the only times I've talked. Yeah, DLF and State Bank, those were my 2 picks for the year.
Okay.
In February, I stand by both of those.
So right now you're saying that you're still in the room doing nothing. You're going to wait.
I'm just, again, I'm worried about the same things everybody's worried about. But, I think that Indian cycle is starting. I don't think it is fully unrecognized. I still don't think it's fully appreciated. So, yeah, I mean, at some point you'll have some kind of correction. U.S. rates will go up. Things are very high. And you'll have another February-like moment, Jan-Feb-like moment, where world markets will go down 8 or 10%. Some emerging markets will go down 25. India might correct 13, 14, 15. And you have to wade in again. So that's been my sort of view in India for a long time, that very rarely do you see obvious signs of selling it aggressively if you're a really long-term investor.
You're also an investor in the non-listed space, right? In the startups, in small companies and stuff like that. Is it looking as promising as ever, or have things slowed down a little bit?
Those are very situation specific. I mean, I think the tech thing clearly got overdone over a year ago, and I was very wary of that. Private valuations have come down dramatically, perhaps not enough, and I'm not sure I understand it well enough to play that. But there are certain areas in fintech that are interesting. I just think that the big trend in India is going to be financial investment, banking, insurance, and the technology adaptation of that. And that's a massive secular trend that is still underserved and underappreciated and underutilized. So the companies that figure those things out, I think, are going to be big winners. I mean, again, this is not a out of the blue idea. Everyone's looking into it and so on, but that doesn't mean that it won't be a winner. So I think in the private space, I think those areas look very interesting.
Okay, one final question. In I think December 2014, Jabong, we had read news reports that Jabong is going to go for $1.2 billion, and that's what Amazon's likely to pay. That didn't work out, and then 1.5 years later, it went for $70 million. Is that a specific individual case of consolidation and competition, or is this something that anyone who looks at startup space, looks at that space where money is flowing, it should look at seriously?
I think it's the latter. I think those things can happen all the time. So I think that's the nature of startup risk, that you have to be aware that the landscape can change dramatically and materially and very, very quickly.
All right. Thanks so much, Madhav Dhar, for
the
taking out time for us. Pleasure talking to you as usual.